We just got the latest inflation data this morning and it really shook up the markets. Now what I want you to do, and what you'll be able to do by the end of this video, is not just look at the numbers and make an opinion, but rather look a little bit deeper and understand what these numbers actually mean, because there's some interesting data that came out with this inflation report that was kind of hidden, especially if you look at what the Federal Reserve Bank has been saying. So I want to start by talking about what the new inflation report said, then I want to talk about inflation, and then I want to talk about the economy. Now, starting with the inflation report, what it said is that headline inflation, CPI, came in at 6.5% from December to December 2022. This was right in line with expectations. This is what economists expected. And what this meant was that between November to December of 2022, inflation fell by 0.1%. So this is what was interpreted as good news, because everybody kept saying that inflation is falling, is on its way down, because now CPI has fallen off of its highs of 9.1%, which is what we got in the middle part of 2022, and now we're all the way down to 6.5%. Now, it's a little bit of a reminder, the Federal Reserve Bank's target inflation is 2%, so we're still much closer to our inflation highs than we are to our target inflation. But then if you dig a little bit deeper, what this inflation report also said was that our core inflation, which is our headline inflation minus what they call the volatile numbers, so if you remove the energy, remove the food costs, our core inflation came in at 5.7%. And this meant that between November to December of 2022, we saw our core inflation rise by 0.3% month over month, which is in line with forecasts. Now, the reason why this is important is because if you kind of backtrack 6 months, 9 months, what the Federal Reserve Bank kept saying, especially when they were doing the big interest rate hikes in 2022, was that they're not looking at the CPI number. That's kind of irrelevant to them. What the Federal Reserve Bank likes to look at is the core inflation number, because according to the Federal Reserve Bank, the core inflation number gives you a better idea of the real inflation, because what the Fed says is that the energy prices, gas prices, and food prices, who uses those, and it just creates a lot of volatility. Now, that's what the Fed said. But today, we're seeing all this positive headlines about inflation, saying inflation's on its way down, CPI fell month over month. But at the same time, what we saw is that core inflation, which is the number that the Federal Reserve Bank likes to look at, rose by 0.3% month over month. So, okay, CPI fell a little bit, but core inflation, which is what the Fed likes to base their decisions off of, looks like it's rising. Now, the reason why CPI saw such a big drop in 2022 overall, although we're still at extremely high CPI, the big factor that led to CPI going down was gas prices. Gas prices have a pretty significant impact on CPI, and what we saw was that, especially towards the end of the year, we saw gas prices fall pretty significantly off of their highs. At the same time, if you look at things like food, I want to go over some of those little numbers. Food costs rose 0.3% month over month, which is pretty high, but it's still better than the previous month where food costs rose by 0.5% month over month. And in addition, the last number that I want to talk about has to do with housing costs, because the CPI data says that in 2022, housing costs rose by 7.5%. Now, if you think about that for a second, that means that in the beginning of 2022, a home that cost, say, $100,000 would be selling for $107,500 today, or at the end of 2022. What most people experienced is much more significant, and that's because, well, the CPI data can kind of be massaged with the way that the Federal Reserve Bank tracks this data, because the CPI doesn't look at actual housing numbers. What they look at is something called owner's equivalent rent. Owner's equivalent rent is where essentially you're not asking homeowners what your home is worth. You're asking homeowners, how much would you rent your home out for if you had to rent out your home tomorrow? Now, many homeowners don't know what the right rental value for their home is, which is why you're seeing the housing costs in CPI so much lower than what actually was seen by so many people. So the real CPI many people experience, a general rule of thumb that people like to follow on the internet, is you take CPI, multiply it by 2, and that's the real CPI inflation that many people are feeling. Now, we keep you up to date on what's happening with inflation, the economy, the housing market, the stock market, and all of the financial news with Market Briefs. Market Briefs is my free financial newsletter. If you haven't joined Market Briefs yet, I would recommend you do so. You can read it in less than 5 minutes every morning, and it's a super easy way for you to stay up to date on what's happening in the market. So if you haven't joined Market Briefs, I'll put the link to how you can join Market Briefs for free down in the description below. Now let's talk about what this means now on the actual inflation side, because on February 1st, 2023, the Federal Reserve Bank is going to announce what they want to do with interest rates again. And in December, when the Federal Reserve Bank rose interest rates by 0.5%, what they said for the first time in this cycle is they're no longer going to look at a snapshot of inflation and our economy and make a decision on interest rates. Instead, what they're going to do is they're going to look at what direction inflation is heading. They're going to look at what direction our economy is heading, and based off of that, they're going to make a decision on interest rates. Now, as a little refresher, the Federal Reserve Bank raises interest rates to bring inflation down, and the consequence of higher interest rates is a slowdown in the economy. What we're seeing is, of course, we're seeing a slowdown in the economy. We've been seeing layoffs, but on the inflation side, inflation is falling. But what is the Federal Reserve Bank actually going to look at when it comes to inflation? Are they going to look at the headline CPI, or are they going to look at core inflation like they've been saying? And at the same time, when is the Federal Reserve Bank going to kind of ease up on the gas pedal? Because yeah, we've been seeing inflation fall, but is it fast enough? I mean, 12 months ago, the Federal Reserve Bank said that we'd be back at almost 2% inflation by now. We're more than double that, or more than triple that actually. So when is the Federal Reserve Bank going to actually ease up? Earlier this week, we got some notes from the Federal Reserve Bank who said essentially that the Fed would rather err on the side of caution, meaning be more aggressive with interest rates, than let inflation run too hot. Now, today, a lot of analysis and economists came out and said essentially that this inflation report gives more fuel for the Federal Reserve Bank to only raise interest rates by 0.25% in February. Now, of course, these are all just predictions and guesses. We don't know what the Federal Reserve Bank is actually going to do, but this is where understanding that the Federal Reserve Bank is going to dictate a lot of, especially short-term movements in things like the stock market, because if the Federal Reserve Bank starts to do smaller interest rate hikes, the stock market will be happy, and that would be more upward pressure on the stock market. But if the Federal Reserve Bank continues to stay aggressive with interest rate hikes, meaning if they keep raising interest rates by 0.5% or more, then that would be more downward pressure on the stock market. However, long term, the higher interest rates still have to play an effect on the economy because it takes time for the interest rates to get absorbed into the economy. I mean, we're seeing pretty much across multiple sectors now, businesses and industries start to get hurt. We've been seeing it across the tech sector. Amazon did the biggest layoffs yet in this cycle. I think it was last week where they laid off a total of 18,000 or so people. But then just in the last couple of days, we saw Goldman Sachs announce that they're going to be laying off a few thousand people. We saw BlackRock, the investment firm, also announce that they're going to be laying off people. Wells Fargo said that they're going to be getting rid of a part of their mortgage division. And we also saw Alphabet, the parent company for Google, announce today that they're going to be adding on to their layoffs as well. So we are seeing a slowdown in the economy. The higher interest rates have a big piece to do with that. And now it's understanding that even if the Federal Reserve Bank didn't raise interest rates, even if they kept interest rates where they are, the higher interest rates that we have seen are going to affect the economy. In addition, the higher inflation is going to affect the economy because even when inflation is falling, this is what you really have to remember. Even when inflation falls from, say, 9% to 6%, that doesn't mean that prices of things have fallen. That just means that prices of things aren't rising as fast as they were before. And 6.5% inflation is still near our record highs. If you look back to before this inflationary cycle, the last time we saw inflation this high was in the early 1980s. So we're still facing extremely high inflation, even at 6.5%, although it feels pretty good when you compare it to 9% inflation. Relative to things before the last 12 months, it is still near our record highs of inflation. So we still have high inflation. The Federal Reserve Bank is still going to be raising interest rates. The high inflation is going to continue eating away at people's ability to spend. That means consumers and businesses are going to not be able to spend as much money. That hurts the economy. At the same time, the Federal Reserve Bank is going to continue raising interest rates. We haven't even absorbed the higher interest rates that we have right now. So higher interest rates, again, will continue to cause more economic pain. And this is where patience is so important for you, because now we have all these factors coming together, and many people are looking at it as a trader, where they expect the impact of higher interest rates or the impact of inflation to hit the markets immediately. That's not the way it works. As an investor, you have to understand the different factors that are happening. That way you can make smart decisions with your money. So the first thing that you want to do before anything else is just make sure you're prepared, have cash aside to protect you and your family. Inflation is still there. The prices of things are still rising quickly. And so if you're not seeing your income grow by at least inflation, that means, well, you're slowly becoming poorer each and every day. So make sure you're working to put some cash aside to protect you. Although your cash is losing value to inflation, you want it to protect you against a slowing economy, against potential layoffs, against your company going under. Then second, you want to have cash aside to be able to capitalize on opportunities. The only way you can capitalize on opportunities is if, one, you're prepared with cash, and second, you're educated enough to take advantage of the opportunities. Looking back, everybody says, man, I wish I would have bought more stocks in 2020. Well, in order to do that, when the crash happened, you had to have had cash, and you had to have known that you should have bought stocks. So you want to be preparing yourself now, getting educated, being aware of what's happening, and also building that, what people call dry powder, building these reserves that we can capitalize on opportunities that might come your way. So this is where it pays to be educated. It pays to live below your means. I know it sucks, especially at a time where the prices of things just keep going up. But this is where you want to be preparing when times are okay. That way you can take advantage of opportunities when times are not so okay.